Welcome back to Protecting Trade Secrets. I'm Professor Seth C. Oranburg. In the first lecture of this module, we explored Frank Knight's distinction between risk and uncertainty, and why trade secret protection operates in both domains. In the second lecture, we examined practical tools for assessing quantifiable risks, vulnerability audits, risk matrices, and the 5W1H framework. Now, in this third lecture, we turn to valuation, the process of quantifying what trade secrets are actually worth. Valuation matters for damages calculations in litigation, for pricing in mergers and acquisitions, for structuring licensing deals, and for deciding how much to invest in protection. But it also matters for something more fundamental. Understanding why a secret is valuable helps you decide how much to protect it. Here's the challenge. Trade secret valuation isn't like appraising a building or pricing a stock. The value of a trade secret depends on who holds it, when they hold it, and what they can do with it. Just as beauty is in the eye of the beholder, a trade secret's value changes depending on whose hands it's in. A manufacturing process might be worth millions to a company with production capacity, but worthless to a competitor without the infrastructure to use it. A customer list might be invaluable to a direct rival, but irrelevant to a company in a different market segment. In this lecture, we'll explore three valuation methodologies: cost to develop, revenue advantage, and licensing comparables. We'll see how each captures a different dimension of value and why context determines which method applies. We'll also examine how valuation under uncertainty requires decision-making tools like regret minimization and scenario thinking. By the end, you'll understand not just how to value trade secrets, but why valuation is itself a strategic exercise, not a mechanical calculation. Let's start with the most intuitive method, cost to develop. The cost to develop method asks, how much did it take to create this trade secret? This approach is grounded in sunk cost, the resources already spent on research, experimentation, personnel, equipment, and time. If your company invested $5 million and 3 years developing a proprietary algorithm, that's your baseline value. The logic is simple. A competitor who misappropriates the algorithm avoids having to spend $5 million in 3 years themselves. They get a shortcut. Courts sometimes use this method when calculating damages, especially when the plaintiff can't prove that the defendant actually used the secret to generate revenue. If you can show that developing the information cost you a specific, documentable amount, you can argue that the misappropriator was unjustly enriched by that amount because they obtained something of value without having to pay the development cost. The cost to develop method also makes intuitive sense to juries. People understand the concept of what it costs to make. If you spent 2 years and hired 10 engineers to perfect a manufacturing process, and a departing employee hands it to a competitor, the jury can grasp that the competitor just saved 2 years and 10 salaries. But this method has significant limitations. First, development costs don't always reflect market value. Imagine you spent $10 million developing a new coating formula, but it turns out the coating only provides a marginal improvement over existing alternatives, and customers aren't willing to pay extra for it. Your development cost was $10 million, but the market value of the secret might be much less. Conversely, you might stumble on a breakthrough after spending only $50,000. But that breakthrough could be worth tens of millions in the marketplace. Second, cost to develop doesn't account for who holds the secret. This is where the beauty is in the eye of the beholder principle becomes critical. Suppose your company develops a proprietary method for optimizing supply chain logistics. It cost you $3 million to create. For you, with your existing infrastructure, distribution network, and customer relationships, that method might generate $20 million in cost savings over 5 years. But if a startup with no logistics operations obtains that method, it might be worth almost nothing because they lack the capacity to deploy it. Cost to develop treats all possessors as equal. It assumes the secret has the same value regardless of who uses it. But that's not how trade secrets actually work. Their value is context dependent. A secret is only worth what someone can do with it, and different actors have vastly different capabilities. This brings us to the second method, revenue advantage. The revenue advantage method asks, How much incremental profit does the trade secret generate for its owner? This approach focuses not on what it costs to create the secret, but on what competitive advantage it provides. If your proprietary manufacturing process allows you to produce widgets 30% cheaper than competitors, you can calculate how much extra profit you earn because of that cost advantage. If your customer list enables your sales team to close deals 20% faster, you can estimate the revenue impact. If your pricing algorithm optimizes margins in real time, you can measure the increased profit over time. This method aligns closely with the legal definition of a trade secret, information that has independent economic value because it's secret. Courts often prefer revenue advantage because it directly addresses whether the information gave the owner a competitive edge. To calculate revenue advantage, you typically compare performance with the secret to a baseline without it. How much more revenue do you generate? How much cost do you avoid? What market share do you capture that you otherwise wouldn't? Let's say your company developed a proprietary customer segmentation model that allows your marketing team to target high-value customers with 40% greater precision than industry norms. You can estimate if your competitors spend $100 per customer acquired and you spend $60 because of your targeting model, then for every 1,000 customers you acquire, you save $40,000. Over a year, that might translate to millions in competitive advantage. This method is especially useful in damages litigation. If a defendant misappropriated your trade secret and used it to compete against you, you can argue that they captured revenue or market share that should have been yours. Courts can award damages based on the revenue the defendant gained or the revenue you lost because of their improper use. But revenue advantage also depends on who holds the secret. Here's where we return to the beholder principle. Imagine your company has a secret formula for a specialized adhesive. For you, with established relationships in the aerospace industry, regulatory approvals, and manufacturing facilities, that formula might generate $50 million in annual revenue. But if a small chemical company with no aerospace customers obtains the same formula, they might struggle to monetize it at all. They lack the distribution channels, the customer trust, the compliance infrastructure. The formula is the same, but its value is radically different depending on who possesses it. This context dependency matters enormously in litigation. When calculating damages, courts ask, what would the defendant have gained by using the secret? Not what would a hypothetical actor gain, but what would this specific defendant, given their capabilities, customer base, and market position, actually be able to extract? That means a trade secret might be worth $10 million in your hands, $50 million in the hands of your largest competitor, and nearly nothing in the hands of an unrelated industry player. Value is not intrinsic, it's relational. The third valuation method looks to the market. What would a willing buyer pay a willing seller for the right to use this trade secret? The licensing comparables method draws on actual licensing deals, royalty rates, and negotiated agreements for similar types of information. If companies in your industry routinely license manufacturing processes for a 5% royalty on net sales, that provides a benchmark for valuing your own process. If software algorithms typically command upfront payments of $1 million plus ongoing royalties, that informs what your algorithm might be worth. Courts often use this method when awarding damages in the form of a reasonable royalty, the amount the defendant should have paid if they'd licensed the trade secret lawfully instead of misappropriating it. Licensing comparables have several advantages. They reflect actual market transactions, not hypothetical calculations. They account for industry norms and competitive dynamics, and they provide a clear defensible number that courts and juries can understand. But finding true comparables is often difficult. Trade secrets are by definition confidential, so licensing deals are rarely public. Even when they are disclosed in SEC filings, for example, the details are often redacted or aggregated. You might know that a company licensed certain intellectual property for $10 million, but you won't know which specific secrets were included, what restrictions applied, or how much of the payment was for patents versus trade secrets. Moreover, licensing deals are negotiated under specific conditions that may not match your situation. A company desperate for cash might license a valuable secret at a discount. A strategic partnership might involve cross-licenses, equity stakes, or non-monetary considerations. These deals don't necessarily reflect the secret's standalone market value. And once again, context matters. The same trade secret might command different royalty rates depending on the licensee's capabilities. Imagine you've developed a proprietary data analytics platform. If you license it to a large enterprise with existing data infrastructure, robust IT teams, and thousands of users ready to deploy it, the platform might generate enormous value quickly and justify a high royalty rate. But if you license the same platform to a smaller company without the infrastructure to integrate it, the value they can extract is limited, and the royalty rate should reflect that. This is not just theoretical. In licensing negotiations, the parties' relative capabilities are central to determining price. A well-resourced licensee with the ability to exploit the secret broadly will pay more than a resource-constrained licensee with limited deployment capacity. The secret hasn't changed, but its value has. Now let's connect valuation back to trade secret law. Remember the third element of the trade secret test: reasonable efforts to maintain secrecy. Courts evaluate whether the owner took steps that are reasonable under the circumstances. And one of the key circumstances is the value of the information. This is where proportionality becomes critical. The level of protection you're expected to provide should be proportionate to the value of what you're protecting. A trade secret worth $100 million demands far more rigorous safeguards than one worth $10,000. If you claim your algorithm is worth tens of millions, but you stored it on an unsecured shared drive, courts will question whether you treated it as valuable. If you argue that your customer list is a crown jewel asset, but you let every sales rep download it to their personal devices, judges will doubt your sincerity. Proportionality means your behavior must match your valuation claims. This creates a strategic feedback loop. Valuation informs protection decisions, and protection decisions signal value. When you invest heavily in safeguarding information, encryption, access controls, monitoring, NDAS, audits, you're sending a message to courts that the information matters. When you treat information casually, you undermine future claims that it was worth protecting. Proportionality also helps companies prioritize resources. Not every piece of confidential information justifies maximum security. A low-value secret might warrant only basic protections: labeling, standard NDAS, routine access restrictions. A high-value secret demands more: segmented access, continuous monitoring, specialized contracts, and regular audits. By valuing your secret systematically, you can allocate protection budgets efficiently, investing heavily where the stakes are highest, and applying lighter controls where the risk-reward calculus doesn't justify more. But here's the challenge. Valuation itself operates under uncertainty. You might estimate that a trade secret is worth $20 million based on revenue projections. But those projections assume stable demand, no competitive disruption, and continued regulatory approval. What if the market shifts? What if a new technology renders your secret obsolete? What if a competitor independently develops a better solution? In conditions of uncertainty, valuation can't be precise. It can only be defensible. This is where strategic decision-making tools from the first lecture become essential. Instead of asking, "What is the secret worth?" you ask, "What would I regret most if I'm wrong?" Regret minimization means erring on the side of overprotection when the downside of underprotection is catastrophic. If losing a particular secret would destroy your competitive position, you protect it aggressively, even if the probability of loss seems low. You're not optimizing for expected value. You're minimizing worst-case regret. Option value means recognizing that protecting a secret preserves future flexibility. A trade secret might not generate revenue today, but keeping it confidential gives you the option to patent it later, license it selectively, or pivot in response to market developments. Once secrecy is lost, that flexibility disappears. Scenario thinking means preparing for multiple possible futures. You don't just value the secret under your best-case assumptions. You model what it's worth if markets contract, if competitors leapfrog your technology, or if regulatory changes limit its use. By stress testing your valuation against different scenarios, you build protections that are robust across a range of outcomes. Let me close with the core insight. Trade secret value is relational, not absolute. A secret has different worth depending on who possesses it, when they possess it, and what they can do with it. A manufacturing process is valuable to a company with factories, not to one without. A customer list is valuable to a direct competitor, not to a firm in an unrelated industry. A pricing algorithm is valuable to a business with real-time data feeds and automated systems, not to one operating manually. This relational quality shapes every aspect of trade secret strategy. It affects how you calculate damages in litigation. You must account for the defendant's actual capacity to exploit the secret, not some idealized use. It affects licensing negotiations. The royalty rate should reflect the licensee's ability to monetize the information. It affects risk assessment. Threats from adversaries with complementary capabilities are far more serious than threats from those without. And it affects how courts evaluate your reasonable efforts. If you claim a secret is extraordinarily valuable, courts will ask whether you protected it as though it were. If your behavior doesn't match your claims, you undermine your case. Beauty is in the eye of the beholder, and so is value. Trade secret valuation is not a technical calculation. It's a strategic judgment that requires understanding not just what the information is, but who might use it, how they might use it, and what that use would mean in a competitive market. Let's recap. The cost to develop method values a trade secret based on what it took to create it. It's intuitive and useful when you can document development expenses, but it doesn't reflect market value or the possessor's capabilities. The revenue advantage method values a secret based on the incremental profit it generates. It aligns with the legal definition of trade secrets and works well for damages calculations, but it requires comparing actual performance to a baseline without the secret. The licensing comparables method values a secret based on what the market would pay for it. It reflects real transactions and industry norms, but finding true comparables is often difficult, and deals are negotiated under specific conditions that may not generalize. All three methods depend on context. A trade secret's value changes depending on who holds it. Different capabilities mean different abilities to extract value from the same information. This relational nature of value shapes litigation strategy, licensing negotiations, risk assessments, and protection decisions. Valuation also connects directly to the reasonable effort standard. The level of protection courts expect is proportionate to the value at stake. By valuing your secret systematically, you can allocate resources efficiently and build a defensible record of judgment. Finally, valuation operates under uncertainty. You can't predict the future with precision, but you can make decisions that are robust across multiple scenarios, that minimize regret in worst-case outcomes, and that preserve flexibility for future choices. In our next module, we'll shift from assessment to action. We'll explore how to design and implement trade secret protection plans that actually work, not just on paper, but in the daily operations of a business. Thanks for listening. See you in the next lecture.